Hey gang, welcome back to another edition of the Forex Market Preview. I am Jason Stapleton, and I'm the guy that kind of walks you through the markets every single day. And I thought today what I would talk a little bit about was just share a little bit of training with you on structure analysis. And every once in a while, we like to come out, and I just like to do a little bit of training, skip the analysis. We'll look into a couple of things that are happening into next week, but just kind of talk with you guys about some of the concepts and ideas that go in that are basic, that are foundational when it comes to reading charts. And one of the very first things that you will learn, or that I teach in any course that we run, is how to read structure, ebb and flow of the market. So what is a new structure high? What is a new structure low? How do you very quickly identify whether a market is trending or not, whether it's in consolidation, whether we're bullish or bearish? And all those things have being able to understand that adds a degree of clarity to your decision making that does not exist for the vast majority of traders who are in the markets today. So I want to take a look at just a couple of things. First of all, we had, in terms of analysis from the Forex Market Preview last week, we did really well. Most of the stuff that we discussed actually ended up hitting. And one of the things we talked about was this pound yen trade. If you remember back to last week, the market had closed right here, and I said, I think we're in for some more downside here. And I said, so you have an opportunity. You can kind of just sell into tomorrow, look for that continued downside. And we identified, looking left, the previous structure resistance level that could potentially become support at around 73.30s, or 173.30s. And I said, for those of you who are of a shorter term persuasion and want to look for a shorter term trade, down on the 60-minute chart, there is a pattern formation setting up. I said you have a nice bat pattern setting up here, and that bat pattern terminates at the 886 around 174.47s. Now, it doesn't matter which one of those you took. It doesn't matter whether you played the counter trend trade, which was whether you paid the long side or the short side. It doesn't matter. Because as the market came down, as you can see, into the week, we drilled down. We came right down into the 886. We just barely tapped it enough to get our orders filled, and then we rallied out. But what you'll notice is we didn't get a huge rally. Wasn't a massive rally out of there, but if I bring in my Fibonacci retracement level, let me just go ahead and delete this. Let me bring in my Fibonacci retracement level, swing high to swing low. And we measure from the high point at A down to where the market terminated at the 886. We see we get a rally of a 382 retracement. Well, that just happens to be the initial targets that we have for our bat pattern. In this case, once target 1 is hit, the stops roll to break even, and the balance was taken out for protective stops for break even. So if you decided to play the bat pattern, you ended up making a little bit of money. And of course, if you ended up playing the longer term trade, well, then you did really well and the market came down again. And guys, all we're doing is just playing off of these pattern formations and looking at what the market has done and where it's going. Let's take a look at something else. Let's take a look at the Japanese yen. Now, on the Japanese yen, this is what I want you to pay attention to. This is what the power of kind of reading charts and what it can do for you. Is that if you'll remember back, I've been talking for a long time. I said the market was moving up into a potential reversal zone, and we identified that potential reversal zone as being right in here. Okay? And this is our higher time frame chart. So what we would do is we wouldn't look for our shorting opportunity here on the daily chart. What we would do is drop down to our trading time frame, and we would try and make our trading decisions off of that. And I identified last week this support line here. And I said, this has been the lowest point, then we got the rally. So what we would look for is a break of structure here against these lows. And of course, you see we got that 2 days of it yesterday, last week, Thursday and Friday, breaking below those structure levels. Now let's drop down to the 60-minute time frame. And I want you to pay attention because this is where structure really begins. This line was drawn on the daily chart. I haven't modified these levels since we did it last week. Previous structure support comes back down in. We hit support again. We hit support again. We hit support again. We hit support again. Market tried to rally out here, was unable to, came back down, and the support level was hit. Once that support level was violated, once we got a break below, close below that support level, look at what happens. Now all of a sudden previous structure support becomes resistance, becomes resistance, becomes resistance. And now we're looking at potentially some continued trend to the downside. So how do you play this? If you're coming into the market this week and you're like, well, I'm not really sure what I'm supposed to be doing here, I'm going to give you several different variations of trades that you can do here. All right, the first thing that you can do is, I'm just going to delete all these other lines. We won't mess with them for right now. Identify the low and identify the high. Okay? The very first thing that you can do, the easiest thing, and also the most aggressive way to do it, is to take the point, the highest point here. So the highs come in at 108.17s. So we're going to go 108.20s. Okay? We're going to drop another line in there. We're going to paint it green. Just going to color this line green. And what this is going to signify, whoops, got to hit apply. What this line is going to signify is a buy stop. What we intend to do if the market comes to this level is to buy. In anticipation that if we violate these previous, this is the highest high, if we violate that high, we're likely into a breakout. And so we want to buy that breakout as soon as it goes out in hopes that we can get a rally. If, on the other hand, the market goes the other direction and at 107.52s are the lows, we're going to go 107.50. Okay, or you can even go 49s with it if you want to give yourself just a little bit more room. Okay, and we're going to paint this line red for a sell. Okay, and if the market violates to the low side, we're going to put sell stops in here at 107.49s in anticipation that if the market goes lower, we're going to get short in hopes that the market will continue in trend to the downside or will continue the pullback that we've seen on our higher time frame chart. That's the easiest way to do it. By far, it is also the most aggressive way to do it. The other thing that we can do is we can delete these buy and sell lines, and we can go ahead and we can look for, I'm going to go ahead and tighten these up to the highest close rather than the highest high and lowest low. And then what we can wait for is if the market violates, if we get a break below, close below the previous lowest low, then the market rallies back up into previous structure support, which should become resistance. We're going to look to sell in anticipation that the market is going to continue lower. Just in the same way that we watched the market break structure here, then rally back up, previous structure support became resistance, selling into that, rallying back up, you could sell into it again in anticipation that we're going to see some lower lows. If the market breaks to the upside, so if we come back the other direction and we go break to the upside, we're going to wait for the retracement back down into previous structure support or resistance, which should now become support and will give us a move higher. Now, what's the pro-con here? Because there's never a right, it's not a right or wrong decision on which one of these you choose or which one of these you use. It's only a matter of pro and con. The pro of the first scenario is that you get into the market as it's breaking out. And so if there is no pullback, what happens if there's no pullback? If there's no pullback and you decided to wait for the pullback where you're just out of the trade, right? And so one of the benefits of waiting, of buying early as the market breaks those highs is that you get in on the run when there may not be a pullback. Also the same thing to the downside. Okay? What's the downside to just buying as soon as the market breaks the highs? Well, what if there's some sort of news event or something came out and the market broke up and then it got beat all the way back down by the end of the candle and then it went and reversed on you? So you tried to get long, then the market, it went up and then it came down and then it reversed. So if you would have waited for a break above, close above, well, then you would have been in a lot better position. So there is a trade-off that happens here. One of them is aggressive, and it puts you in the trade even if there isn't a retest. But if you use the retest, well, what you've done is you've confirmed, yes, the market does intend to go higher. It did break above and close above. There is a high probability chance that we're going to see continued move in that direction. So those are all things that you have to think about in your trading plan as you're making these decisions. Let's go ahead and have a look at Canada. I have it on my list today. All right, let's go on out to the daily chart. Let me just see what we talked about. Actually, I'm going to leave Canada alone, and let's just go over and look at Euro Pound. Euro Pound uses this same philosophy. If you were in the syndicate, if you were in War Room with me this week, this was one of the trades that I took on Friday, I believe. No, was it Friday? No, it was Thursday. No, it was Friday. I'll have to look at my trade record to find out when we took this trade. But it was the same basic principle, okay? Market had put in a previous structure support level. The market violated that level. We rallied back up in. Previous structure support should become resistance. I sold, I think it's 78.84s or 78.80s. I can't remember. Now trading 78.52s. The market came in, respected that structure, and moved lower. And guys, you can go back to this move, this most recent move that we've had. And you can just look at the way that structure plays a part. We come down, we rally back up, market puts in a lower low, lower close. We rally back up, we don't violate the highs. See the highs right here? They're not violated. Then we break down again. We rally up, look left. Structure leaves clues, right back down into that previous structure level. Then we drop again. Then we rally back up. Coming almost up into that structure level, not quite before the market rolls over. New lower low, lower close. Then we rally back up. Look left. The structure leaves clues. There's that previous structure level. Then the market drops again. We get a little short-term rally, not enough to get involved in. Then we come down. Then we rally back up. Look left. Structure leaves clues, giving you a shorting opportunity back down into the double bottom that leads us into a little bullish relief rally. Right? Now, there are actually some advanced strategies that we can use on this, and some of you guys who are in the syndicate, who've been in War Room with me, will recognize some of this stuff, but we can do a Fibonacci inversion here, looking for the 1618 extension for an opportunity to sell, looking for that continued downside. There are lots of different trades that we can make when we've been in a heavy downtrend and the market gives us a break of structure. Lots of ways to continue to stay with that trend. But at its core, what we're talking about here is just simply reading structure. Lower low, lower close. Wait for the pullback. Back up into previous structure support. Should become resistance. Look at how many times you had that opportunity. You had one here. You had one here. You had one here during the course of this down move. Lots of opportunities for you guys to be involved in that trade if you so choose. And now we've come back up in, the market's made another down leg, and we're selling into that down leg looking for some continued downside momentum. So, guys, as you go out this week, just grab a chart. Spend 10 minutes, spend 20 minutes taking a look at the chart and going through these and looking for higher highs, higher closes, and looking for that previous structure support becomes resistance. You'll be surprised how often you'll find that this plays a heavy role in what the market does. And it's going to give you a very easy way to profit for those of you guys who like to be with the trend, who like to be with the direction of the underlying move. This is a great way for you to do that. So I hope you enjoyed the video this week. If you did, please like the video, please share the video, please subscribe to the YouTube page, and then tell your friends about it, because the only reason I do this is for you guys. There's nothing in it for me. So until next time, good luck and good trading. I'll talk to you soon.